Thank you, Steve.
Okay, thank you. Well, good morning to everybody and a happy new year to you all, and welcome to this first webinar of 2021 on succession planning. Just as a quick reminder before we get going, you're all on mute at the moment. If you want to jump in with a question, please feel free to unmute yourself and just shout out a question. It's all meant to be very interactive. We're not here just to talk at you. If you've got a question, you don't want to unmute yourself, there's a chat box and you'll see a speech bubble on your screen. Please feel free to post your questions in the speech bubble and we can go through all of those at the end. The session is being recorded and will appear on our YouTube channel later on today. And if you go to there, we'd love you all, please subscribe to the YouTube channel because there's going to be a lot happening during 2021 from us. So you'll be notified of any new webinars or any new podcasts or posts which are going up on that channel automatically. So make sure you subscribe so you don't actually miss anything. As I say, you can go back and have a look if you think you've missed anything, or if you've got any questions and you want to speak to us on a one-to-one basis, please feel free to give us a call in the office and we can actually get in touch with you. As we can appreciate, we're now in lockdown version 3, and no doubt this is going to affect everybody. Government support is changing all the time. So what we need to do is just wait for all the full details to come out. Stuff is coming out all the time, and we will update you all or by email, or if you're not on our email list, just jump onto our website, have a look on there, and there'll be plenty of information that'll be posted up there. One thing I just want to stress for 2021 is that you all should be looking at doing a strategic plan for the new year. Times are tough. We're going to be in the biggest recession the world's ever seen, according to some economists. So it'd be a great time to get a strategic planning session done. This is just a half-day session, and we can come out with a 5-year plan for you all. And just to incentivize you all, we actually have a free prize draw on at the moment. Go to our website for more details, and the prize is the first Strapped planning session, the first half-day session for you. So please log on to the website, join in the prize draw. That's going to be open until the end of the month, out of which then we'll pick out the winner, and you'll get a free half-day session with us. Right, that's all I've got to say just for the moment. So I'm going to hand you over to Chris Bentley and Alison Ward, who are going to take you through succession planning for this morning. So it's over to you, Chris.
Thank you, Stephen. Thank you. It's Chris Bentley here. Alison will hop on to present parts of this webinar as well. I'm tax director here at Hart. Alison is tax manager. And between ourselves, we're going to talk about succession planning, or perhaps passing on value. This isn't just about passing on business assets. It's around your estate planning generally. If you just flick onto the disclaimer, please, Stephen. Do have to put an obligatory disclaimer up on these things, but it's worth stressing that in the case of this webinar, it really is the case that it's important to discuss in detail before going ahead. The idea behind today's webinar is really to talk about what might be possible. Inheritance tax, passing on value, succession, whatever you might want to call it, is an area where the correct answer very much depends on the family's personal circumstances, preferences and requirements. There is very definitely not a one-size-fits-all solution, and therefore it's impossible to give advice without a detailed discussion to fully understand the background, your aims, wants and needs. That said, hopefully from today's session you should have an idea of what might be possible. And then diving into the next slide, we have set out the major areas of wealth that an individual might have, ranging from trading businesses, investments, property income and main home. It's unusual for people to have large cash balances sat around that haven't been invested, whether in stock market, equity, property, a bigger house. However, if you did have cash, it would be somewhere between trading business and investments in terms of that list. Now, I've deliberately put the major asset classes that an individual might have in the order that they're shown. The ones at the top, or the one at the top, is privileged from an inheritance tax perspective, in that it can be passed on without, in many cases, without any inheritance tax charges. Other investments in property, it's unusual for that to be the case. Your main home is very difficult to do anything about from an inheritance tax perspective. However, within that, there are also different gradations. For example, cash, we don't have to worry about capital gains tax. Investments can be relatively liquid. You might be able to transfer them over a number of years and therefore avoid any capital gains tax problems that way, while still having to deal with inheritance tax. Property's harder because you either own it or you don't. You might be able to pass on a half share, but it's compared to disposing of, say, listed investments, funds, equities, etc., far more difficult to break them up. And then your main home, as we'll come on to, it is very difficult to plan inheritance tax plan around the main home. So if I can move on to the next slide about trading businesses, the point I've made already and that I would stress again is that your interest in your business, looking at the list, I think most of you have limited companies and trade through limited companies rather than as partnerships, but the principles are the same. Those shares or your interest in a partnership or sole trader business is privileged from an inheritance tax perspective. If you were to die tomorrow, we would expect the value of the business to attract something called business property relief, which reduces the value of that asset for most inheritance tax purposes. I'll say effectively reduces it to nil. That, of course, affects the planning you might undertake. So if I look at some things, first of all, that you might consider doing during your lifetime as opposed to deathbed or will planning, the first of those is actually outright gifts of shares. In some families, it's the case that the next generation is going to take on the business, they want to be involved, and therefore it actually makes a lot of sense for some shares to be transferred to the next generation within their lifetimes. It can be done piecemeal, or it can be done as one fell swoop. Because it's inheritance tax privileged, we don't need to worry about surviving 7 years in most cases, and also there are capital gains tax reliefs which can avoid there being an immediate capital gains tax charge. However, there are downsides. If you do this, you're giving up control of your asset. If you need the income from it, you're giving up that income. If the next generation goes and gets divorced, you've got the problem of the divorce courts and potentially a former spouse running off with quite a lot of the value. So it's not for everyone. Another thing that people sometimes look at, even within their lifetime, is the use of a discretionary trust. Can't do that if you want to benefit from the income going forward from dividends. Nothing to stop you going on payroll, but from dividends. And you also can't use discretionary trusts for minor children. However, if your next generation are now into their 20s or 30s, in certain circumstances, they can be very useful vehicles to protect part of the family's interests. One example I've got of that we've looked at recently is we have a business owner who is in his 50s. He has 2 adult children in the business who are about age 30, but has recently remarried, having divorced. His new wife is in her 20s, and the likelihood is that there will be further children. Now, our business owner is keen to protect the interest his sons from his first marriage would ordinarily have, and effectively to divide his estate or future estate in half. So what he's done is he's put a 49% shareholding in the business into a discretionary trust for the benefit of his 2 adult sons and their issue, which already includes at least 2 grandchildren. But again, he's lucky because he doesn't need all of the income from the business. He has adult sons, so the planning works, and it's also a sizable business. For many people, that will perhaps be going beyond what's needed, but for others, such as this business owner, it's a very good way of protecting assets for both parts of the family. And for him, the protection was huge. Having been divorced once, he fears that his sons might get divorced in the future, and it is one way that he can ensure that that value will be passed down to his grandchildren, ultimately. Also, I'd add that the planning can remain effective even if the business is sold in the future, albeit it won't be as tax efficient as it would have been had the trust continued to own shares in a trading business as opposed to owning cash following the sale of that. But I'll just stress at the end, that final point, the correct lifetime giving strategy does depend on the donor's need for control of their business, their need for income, the need for flexibility in the structure, and whether ongoing protection of that asset is required. Now, if you could flip over, Stephen. Thank you. But let's say you're now in a position where you're in the unfortunate position of you've received a terminal prognosis. You know you haven't got long left, or you're helping a family member who's in that situation, or for the advisors amongst their clients in that situation. All is not lost. With trading businesses, it is more than give away and survive 7 years. There are cases where, on a detailed investigation of the facts, it might be possible to reorganise the dying individual's estate, potentially by way of giving away the shares in the business a year before death, which has the effect of rescuing the residence nil rate band. Now, the residence nil rate band is an additional £175,000 or up to £350,000 for a couple that is available to anyone who leaves an estate of less than 2 million to their direct descendants, and that estate includes value relating to their main home. Complicated, and I don't want to go into too much detail on that now, but the reason it's mentioned is that the 2 million test there is applied to the value of the estate, including business property, even if that business property qualifies for relief, and it's also applied at the date of death itself. So you could give something away the day before you die, and that gift is effective for the purposes of the residence nil rate band. Another thing that might be possible is if you have a reluctant shareholder in the company, someone who's not going to be involved going forward, and also some surplus cash, then it may be possible to use that cash to buy out the unwilling shareholder. That not only simplifies who's around when it comes to the dealing with the company after the individual's death, but it also means that the surplus cash, which probably isn't going to be privileged from an inheritance tax perspective, has left the estate. And again, that should be immediately effective for inheritance tax purposes. We have actually done both of those plannings with clients in the last 12 to 18 months.
Go down. Go down.
I've mentioned trust previously, and so I've mentioned it again. There's no reason why, even if a trust's not appropriate during lifetime, why one couldn't be incorporated in the will to give the flexibility and protection aspects. Or perhaps it's as simple as you want some of the business to benefit your grandchildren rather than the next generation. And finally, if you're in this situation, it's worth considering how the estate is to be divided. particularly if you're in a position where you have one child who is in the business and another who is outside the business. In that position, how are you going to manage it so that you get both equitable interests and you don't end up with the siblings potentially falling out over who runs the business? All of this is an awful lot easier with a will. And at this point, I'm going to hand over to Alison, who will take you through the next parts and what happens without a will. Before I do so, I think someone's got their microphone on and a bit of background noise.
Chris, can you just, it's Martin, can you just mute Martin? You can just click on his name on the list of names and right click and mute him, or just click on his microphone button.
Brilliant, thank you, Stephen.
Hi, good morning everyone. So if we could just move to the next slide, Stephen. And what we're going to talk about now is what happens if you die without having made a will. Because if that happens, then your estate is going to be divided up according to the intestacy rules. Now, the rules in England and Wales are what we're going to talk about because they are slightly different in Scotland. So we're just going to focus on England and Wales. And we've got different scenarios here depending on what relatives you've left behind. So in the first scenario, if you're survived by a spouse or a civil partner and you also have children, then that spouse or civil partner will get the assets, so mainly the home, plus up to 270,000 of personal possessions. And then they will also get an absolute interest in half of anything left above that. Then the children will get the other half of anything left. If they're underage, if they're under 18, then that will be left in trust for them until they turn 18. Second scenario, if you have no children, you're just survived by your spouse or your civil partner, then everything will obviously go to them. If you have no legal spouse or civil partner, but you have children, then the children are going to receive the proceeds of the entire estate once they're 18, again, be held in trust for them until that point. But if you've maybe been cohabiting for a number of years and you're not legally married, then your significant other half is not going to get anything under the intestacy rules. If we move on to the next slide, then if you've got no civil legal spouse and no children either, then basically we have to start looking at what other relatives have survived you, and there is an order to this. So if you have surviving parents, then they're going to inherit. If you don't have surviving parents, then it moves on to your siblings. Or if your siblings have died before you, but they have children, then they can inherit their share. If you have no siblings, then it actually goes to grandparents, who it's very rare that they would be surviving if you have no siblings or parents. And after that point, it then goes to your uncles, your aunts, or if they have predeceased, then children, so your cousins basically. And if you have no surviving blood relatives at all, then your estate will pass entirely to the Crown. And if we just move on to the next slide, just a few points to note. So as we've said, this is the rules totally dependent on the relatives you've left behind. It takes no account whatsoever of the closeness of relationships that you might have had during your lifetime, or even the need to inherit your estate. The intestacy rules will apply if you have no will, or if your will is found to be invalid. So there are a number of instances where that could be the case. A key one is if you've made a will and then you remarry, your existing will is automatically invalid. You need to make a new will if you remarry. So, you know, you can come across some scare stories basically of things that have happened where there's children from a first marriage and somebody wants to make sure that they protect the assets for those children and they make a will in their favour, but then they remarry and they don't think to remake that will to make sure they're still making provision for the children from the first marriage. And what you find there is that on their death, they will have died intestate, and as we've seen from the previous slides, the surviving spouse will then inherit in preference to the children. So another point to note is that if you own any property as joint tenants with your other half, married or unmarried, then that will automatically pass to them as the surviving joint owner. So we're talking about property, bank accounts, etc. So that won't fall under the intestacy rules, that will follow the joint tenants rules. When we're talking about children inheriting, then we're talking biological and adopted. They are treated the same, but there is no provision for stepchildren. So again, you may have a stepchild that you're very, very close to, you would want them to inherit, but under the intestacy rules, they would not get any provision. And as we've said, you know, if you've got a long-term partner that you've been cohabiting with, then a will is extremely important, because unless you've got jointly owned assets, they're not going to get any provision from your estate without that will. Okay, so if we move on to the next slide. So what we're going to talk about now is the next sort of slice of assets that Chris mentioned, investments and property, and how we pass these on to the next generation, because they are not tax advantaged like trading businesses. So we have a couple of scenarios here, and as we said at the beginning, each scenario would fit a certain set of circumstances. It really does depend on what you're trying to achieve. So in this example, we're imagining that someone's got a rental property that is worth, say, around £300,000, and you might be wanting to get the value of this asset out of your estate, and at the same time you want to maybe pass on the rental income. So maybe you have children, adult children, that you're trying to get this income to them so they can maybe spend it on your grandchildren for school fees or, you know, after school activities, that kind of thing. So one option might be to think, well, I'll just transfer that property outright to my children, so then they've got the rent and they can do what they like with it. And obviously I don't own that property anymore, it's not in my estate. The upside to that is that whenever you make a transfer outright like that, it is considered a potentially exempt transfer for inheritance tax. As long as you survive the 7-year period, then it will fall completely outside of your estate. But the downside is that making that outright transfer to what's known as a connected party, a relative, it will be a transfer at market value. And you'll have to consider the capital gains tax implications there. And you would be looking at paying either 18% or 28% capital gains tax on the increase in the value since you've owned that property. And a further downside is that your children would also then be the people who are receiving the rental income, and they're going to get taxed on that on their own self-assessment returns. And if they're higher rate, then they'd be paying 40–45% on that rental income. So a more tax efficient alternative is to transfer this property into a discretionary trust. What we have with that is when you transfer something into a discretionary trust, there is something called an immediate charge to inheritance tax. But the property, remember, is worth £300,000. So that is below the current nil rate threshold of £325,000, which means there is no inheritance tax to pay on that immediate transfer. But because we're transferring into trust, we can trigger what's known as a special capital gains tax holdover relief, which means there's also no capital gains tax. So we've got the property into the trust and we've avoided CGT and IHT. Now the rental income is being received by the trustees, and what can happen then is they can make income distributions. So you could be a trustee of the trust and you can make income distributions out to the grandchildren. If you make the grandchildren beneficiaries, then the income becomes the grandchildren's. Now, the rental income is taxed within the trust and it is taxed at 45%, but the grandchildren will receive this income net of a 45% tax credit. And they'll have their own personal allowance of 12.5%, and it's quite likely they're not using the basic rate because they might be minors. So that means that they can effectively make a repayment claim of the 45% tax that's been suffered by the trust. So you can see it is a tax efficient way of getting that property out of your estate and passing the income on to the next generation. So aside from the tax benefits of a trust, they can also provide control for who inherits and when they inherit. So you've got the asset protection there. Again, if you're worried about your children or your grandchildren making bad marriages, or if they're not good with money. Obviously, you can't see into the future, you don't know what they're going to be like. So that is another good reason for using a trust. We've talked about it being a property that you would put into this trust, but the same can be said for if you've got an investment of company shares. You can put those into a discretionary trust, and the dividend income that's being generated can be paid out to the lower tax-paying or non-tax-paying beneficiaries in the same way. So if we move on to the next, we'll leave where we are. The next option is, rather than using a trust, if we just go back a slide, sorry, Stephen. The next option, rather than using a trust, is to use what's known as a family investment company. Now, one downside to a trust is that if you want to retain any sort of interest at all in the assets that you're passing on, then you make that trust what's known as a settler in interested trust, and it taints the tax benefits and makes the tax planning that we've just talked about ineffective. Whereas with the family investment company, you can actually retain an interest, you can have some shares in this company, and then you can give all the shares out to the rest of the family. The family investment company also works for assets that are worth more than $325,000 that you're trying to give away. Although we have to be careful if we're trying to transfer property into a family investment company, because there would be possibly a CGT, capital gains tax charge at this point. It's usually more tax efficient if it's cash that's being transferred into this trust, and then the actual investments are bought by the family investment company itself. So an example of how one of these might work. So the parents might form a limited company, and they would take one A share each. And those A shares would have the right to vote, but they'd have no entitlement to dividends or return of capital. And then the children would have one B share each. And those shares would have no voting or control rights, but they'd have a full entitlement to dividends. And the parents may fund this company either by gifting in cash or by way of a loan, a director's loan. So then the assets that are purchased by that company are going to generate the income. And this income is going to be initially reinvested or used to repay the director's loan over time. You wouldn't want to pay out dividends, because you'd then potentially be looking at double taxation, because obviously dividends that are paid out above the £2,000 dividend allowance are going to be taxable at the individual shareholder's highest rate of tax. Now, you might think, well, I'm paying the dividends out to the children. If the children are under 18 and you pay the dividends out to them, then there's an anti-avoidance that kicks in, which basically says it's the parents' income. So you would only be looking at paying out dividends to the children once they were over 18. So benefits of this, the profit within the company gets taxed at corporation tax rates, which is lower than the 45% that a trust is paying on income. Assets that are sold within the company, they pay capital gains at the corporation tax rates. Again, that's lower than what an individual would pay or trustees pay on capital gains. But the key thing with this type of planning is that it does work best for long-term wealth planning, where you're holding the income and the capital within the company for a long period of time. Because as we said, once you start paying out the income straight away, you're just hitting double taxation with the corporation tax and then the income tax on the dividends. So there are some downsides to this, in that you have to follow Companies House statutory regulations and you have to file companies accounts. There will be quite a significant cost to establishing this, which will be more expensive than establishing a trust. And they are potentially an area of HMRC focus. So it is very, very important that the setup of these companies is done correctly and thought through from the start, because they can potentially, if not done correctly, trigger some anti-avoidance rules such as settlements legislation and transactions in security. So there are two different vehicles, and they are basically aimed at two different sets of circumstances. In the first one, we were talking about somebody who has got income and he wants to be able to pass it on so it can be used, plus the asset is below the nil rate band, And in the second scenario, we're talking about a more long-term planning strategy. The income shouldn't be being used straight away to be most tax efficient. And we're obviously talking about expensive assets that are more than the nil rate band. So finally, just on this slide, just to mention that there are ways to give during your lifetime which are completely free from inheritance tax. We do have some exemptions, if you like. The first one is called the annual exemption, and it's basically an individual can give away up to £3,000 per annum, and you don't have to count that as being under the 7-year rule. So it's not considered a pet, it's just considered it completely exempt. And if you haven't given anything away in the previous tax year, you've still got your £3,000 unused, you can carry that forward at one tax year. So you could give up to a maximum of £6,000 in one tax year. And if you're a married couple and you want to gift to children, then obviously you've each got those exemptions. So it's potentially £6,000 each that you can give as a couple to children or anybody you like. We then have a small gifts exemption, which is up to £250 per person. So there's no maximum number of small gifts you can make in a year. It's just as long as it's no more than £250 to one particular person. And then we have something called wedding gifts, which you can give up to a certain amount depending on your relationship to that person. So if it's no relation at all, just anybody, a friend, then you can give up to £1,000 to that person on the occasion of their marriage. If it's a grandchild, then you can actually give a bit more, so it's £2,500. And if it's your child, you can actually give £5,000 on the occasion of their marriage. And then the final one, which is often overlooked but can be quite important, is you can give gifts out of your surplus income. Now, and these are completely tax-free. So if you've got excess surplus income, then you can be giving gifts that they have to be habitual, there has to be a pattern to them, and they have to not affect your standard of living. So what HMRC are looking at is that your income coming in, once you've taken out all of your outgoings, what you've got left, can you then still afford to be making those habitual gifts without it affecting your standard of living? And if that's the case, then they're saying it's out of surplus income and it falls under this exemption. Okay, so if we move on to the next slide. Yeah, thank you, Stephen. So finally, we're talking about planning with your main home. Now, Chris mentioned earlier that this is very difficult to do any sort of lifetime planning, trying to gift it to your children, but then you carry on living there. That is largely ineffective. Because of two tax legislation, really. The first one is called a gift with reservation of benefit. So whenever you gift an asset that you then continue to enjoy some benefit from, it falls within this gift with reservation of benefit. And what will happen is, if you did that, if you transfer the property into the name of your children, but you carried on living there, at the date you died, that house is still considered to be part of your estate, and the value will still be counted when we're looking at your IHT position. With most assets, you will have triggered the capital gains tax, though, at the point you made the transfer. So you can be hit with a double whammy, that you pay the capital gains in your lifetime and then it's not been effective for inheritance tax when you die. Obviously, if we're talking about your main home, you'd be able to claim the main residence relief on the transfer, but the point is it still remains ineffective for your estate planning. And if you don't get caught with gifts with reservation of benefit, then you generally get caught by something else called the pre-owned assets tax, which I won't go into too much detail, but basically you end up with an income tax charge on an annual basis. So this type of planning, people have tried various schemes, and they've been a big area of HMRC case law. A couple of exceptions have come out of it. If your children move in, you basically cohabit, and then you share expenses, so you all co-own the house and you're sharing expenses, then that can be effective. Or if you transfer the house and then you pay a market rent to your children for you to continue to occupy that property. But you can get caught out in this if you don't keep a review of the rent you're paying, because it has to be increased in line with market conditions. And if it doesn't, then at that point you fall foul of the gift reservation of benefit rules. So the way most people can pass on their home effectively is on their death through their will. And as we've talked about, there is this residence nil rate band, which is currently £175,000 for deaths occurring after 6th of April 2020. The conditions attached to that is it has to be a property that was once a residence of the deceased. It doesn't necessarily have to be the property they were living at the time. And it has to be being passed on to direct descendants, so children, grandchildren. As we've already mentioned, it does get tapered if your value of your estate goes over 2 million. And this is before, as we've already said, reliefs and exemptions. So it is often the reason why you should be looking at the other assets in your estate and thinking, what can I do with those? How can I get those out of my estate to try and bring the total value back below 2 million so that you retain this residence nil rate band. So there is the ability to transfer the unused residence nil rate band to a surviving spouse, just like there is with the current normal nil rate band. So if everything gets passed on the first death to the surviving spouse and they don't get used, they can then be doubled up on the second death. There is also something called a downsizing addition, or a provision where you've obviously downsized to a lesser value house, or maybe even sold that house entirely. So say you end up going into a care home and you sell your property because you don't need it anymore before you go into that home, then the value that you receive into your estate, the proceeds from that, as long as you are then passing that on to direct descendants, then this downsizing addition can come into play. They are quite a complicated set of rules, so it's not something we're going to go into detail on here. So, I mean, most people do think about trying to pass the house on during their lifetime because they're worried about protecting their estate from care home fees. They want to make sure their children inherit. But it is tricky, as we've outlined. It doesn't work from a tax point of view, and also from the local authorities' point of view. They have a rule called deliberate deprivation. So if you've deliberately, got rid of an asset with trying to avoid a care cost, then they can come along and still include the value of that property in your total assets when looking at what your contribution you have to make to your care costs. But there is something that you can do if you're a couple and you own a house, and most couples own their property, their main home, as joint tenants, which, as we've already discussed, means that it would pass automatically to the surviving owner. What you can do is you can actually change that ownership. So you would get a solicitor to change it to something called tenants in common, which then means that each individual spouse is free to leave their share through their will to somebody else. So they might decide, well, I'll leave it to the children. So you both set up identical wills, saying I'm the first to die. I pass my half to my children, and you make a provision to say the surviving spouse has the right to live in that property for as long as they want. So you are protecting the home as much as you can for the spouse to continue living it, but you've actually passed ownership of your half share out of your spouse's hands and into the children. Now, it is valid planning because you are ensuring that your children will get some of your estate eventually, because you might be concerned, well, what happens if my surviving spouse remarries? She owns then, or he owns all the house. My children eventually might get nothing. So it is valid planning, but the added benefit is that if then the surviving spouse should need care home, to go into a care home, then only half of the value of the house will be counted towards the care home costs. And the surviving spouse here has not breached the deliberate deprivation rules because it wasn't theirs in the first place. So that is something to perhaps think about in terms of protecting half at least of the property. And at this point, I'm going to pass back to Chris to talk about some wider tax planning.
Yes, thank you, Alison. Hang on, you've stolen mine. Sorry. Yes, I've got my notes back now. So yes, it's not just about what's left at death. It's also a case of what should be left at death. Let's take the example at the moment. You've got your trading business. The next generation aren't keen to take it on. What do? Well, it might be a case of it's better to sell that business to a third party at the moment and realise a large sum of cash. It might be that the management team want to take it over by way of a management buyout, or even that you put it into something called an employee ownership trust. That's something which is very tax efficient for the departing owner, in that there's no capital gains tax at all to pay. There's a trust that can pay for it over a number of years of profits. But on the downside, it does mean every single one of your staff has to be an owner of the business through the trust. So not for everyone, but worth considering in the right circumstances. The benefit from selling the business during your lifetime, as opposed to leaving it to your heirs in your will and for them to deal with, is that you have control over who takes on the business. But if you've now got cash as opposed to shares in a business, then you've suddenly gone from having a very tax advantaged asset to something that's not tax advantaged. So if you sell the business, you do need to revisit your IHT planning, your inheritance tax planning, and your will. It may well be that what was appropriate previously is no longer appropriate. I'll give you by way of an example a client we dealt with about 5 years ago, an elderly gentleman just coming up to his 80th birthday. He was a widower with 4 children and multiple grandchildren and had remarried, so following being widowed. Now, he had a business that he sold for roughly 2 million, and he sold it on Christmas Eve, told his second wife that he'd sold it on Boxing Day, and then turned up in our offices in the new year with his granddaughter. Now, what came out at that point was that previously the intention had been that on his death, his 4 children would each take a 24% shareholding in the business, with the remaining 4% to go to his granddaughter to act as referee between them. The siblings did not get on. From an inheritance tax perspective, that was all good planning, because the value of the business would have passed without there being inheritance tax to pay. We now had a position where we had an 80-year-old or 79-year-old with 2 million of cash in his estate, and was potentially therefore looking at an additional inheritance tax charge at 40% of £800,000 as a consequence of having sold his business. Now, this gentleman decided that he didn't need the cash, and he therefore gave it to his 4 children. Remember, he was married, but second wife, she had her own children and separate provisions, so he gave it to his 4 children, made sure it ended up where it was intended to end up, and because the will talked about gifts of shares in the business to those children. It also started the 7-year clock running from an inheritance tax perspective in terms of that asset falling outside his estate. Now, this gentleman, I think, has now made 5 years, or has almost made 5 years, so he's nearly there with his 7-year planning. But it's just an example of the real need that, should you sell your business, to revisit your inheritance tax planning and not rely on what you'd put in place previously still being appropriate. Now, the final point I've just got on there is deeds of variation. I wouldn't have called these necessary succession planning, but last chance saloon. If you get to a situation where someone has died and their will is crazy in terms of the planning, who it sent things to, probably because it's not been looked at, it is possible to use something known as a deed of variation to alter that will post-death to put the affairs in order. But I mention it as something that might be a get out of prison card rather than something that should be relied on as a planning tool. And that actually brings us to the end of the inheritance tax succession planning part of this webinar. Stephen just flicks onto the next slide.
Yeah, thank you, Chris. Thank you, Chris. Thank you, Alison. Very informative. Has anybody got any questions before we finish off this morning? While you're thinking of something, if you want to stick it in the chat box, feel free. If you want to unmute yourself, again, feel free. Our next webinar is going to be on the 27th of January, towards the end of this month. It won't be on tax because they're going to be busy filing the last few tax returns, which need to be in still need to be in by the end of the month. That deadline hasn't been relaxed. And this one's going to be on how to utilise social media to grow your business and make more profit, both in lockdown and beyond. So I think it's going to be a useful one because by the looks of it, we're not going to be out of lockdown by the end of the month. It's going to go on for a bit longer than that. So it's well worth coming along on that, and hopefully we can help you on that. Right, we have a couple of questions that have come in. First one is on anything on commercial property held in a SIP. Over to you, Chris. How would that be affected?
I think if it's in a SIP, the chances are that the SIP is outside your estate.
Okay. Another question, would an untouched pension pot of, say, 600,000 count towards the £2 million for IHT purposes?
Again, it would depend on the wording of the pension, but in almost all cases, I was about to say most, but probably almost all cases, because it's in a pension, it would fall outside the estate.
Great, thank you. One from Mark, can you elaborate on the position relating to second homes which may be abroad?
Yeah. So in terms of if you are England and Wales domiciled, which looking at the list of people on here, I think pretty much everyone will be. That is anyone whose ultimate home is the UK, anyone who is originally from the UK, and anyone who is deemed domiciled by having spent the last, has it gone to 15 years now, Alison, for IHT as well? 15 out of the last 20 years resident in the UK, you will be domiciled in the UK at your death. It's quite difficult to get rid of that once you've acquired it. Those people are subject to UK inheritance tax on their worldwide assets. So your foreign property will be dealt with in exactly the same way as your UK property and what we've talked about there.
But you do need to just check whether there's any sort of specific succession rules, because I think it's France has succession rules about property, and that might take precedence.
Yeah, many European jurisdictions do have forced succession rules. So even if you're not worrying about it from a tax perspective in France, Spain, wherever, you may well not be able to pass that asset on as you choose because of French, Spanish, whatever rules. You'll need to take local advice as to the local position for that asset.
Okay, great. Just a reminder from Ian, who said with a pension there would need to be an up-to-date nomination of beneficiary. The pension pot also helps with long-term care planning. Ian is an IFA and deals with this as well, so it's worth looking at. Any planning tips re 100% shareholding private company owning residential letting properties?
Unfortunately not. You'll have noticed that when I talked about the tax efficient or tax privileged asset, I was keen to stress this was a trading business. The inheritance tax relief only applies to trading businesses, and that's why surplus cash in a trading business can be a problem. Residential property is seen as investment by the revenue, and the test for residential property to become trading is set extremely high by the courts. Even some of the most serviced holiday lets are still seen as investment property for this purpose. So if you've got a limited company full of residential property, you're looking at the planning we've talked about for investment assets.
Okay, thank you. Question from Zoe. Yes, will this be available as a recording? Yes, it is. It is available up on our YouTube channel later on today. So please feel free to subscribe to the YouTube channel when you get there, and you'll make sure you get any copies of any future recordings as well as and when they go up there. And as I say, there's going to be a lot happening through 2021. On the basis that nobody else is asking any more questions, just like to remind you that we still have our prize draw for a free strategic planning session. That prize draw is open until the end of this month, and that's where a free half-day session to get your 5-year strategic plan out, which we think is absolutely vitally important to you. So anyone who's interested, please go to the website and log on and have a look at that. But again, thank you very much indeed for everybody for attending this morning, and have a great day. Great, thanks.
Thank you, Stephen.